The best times to trade are rarely the times when you feel most eager, most alert, or most afraid of missing out. And this is where many traders quietly sabotage themselves without realizing it. Optimizing your trading schedule is not about finding a magical hour where profits are guaranteed, but about aligning market behavior with your cognitive energy, emotional stability, and strategic edge. Trading literature, written by long-term professionals, consistently reveals the same truth. Time is not just a backdrop for trading. It is an active variable that shapes volatility, liquidity, decision quality, and ultimately, consistency. Markets move differently at different times for structural reasons, not superstition. Sessions overlap, liquidity enters, and exits, institutions rebalance, and information is digested unevenly. These rhythms create windows where price discovery is active and windows where noise dominates. Understanding this rhythm is the first step in optimizing a trading schedule. For example, the opening phase of a major market session often brings expansion volatility and emotional release. This can create opportunity, but it also magnifies mistakes. Trading during these hours requires clarity, preparation, and strict rules because the market is moving before consensus is formed. Mid-session periods, by contrast, often reflect digestion rather than discovery. Volume stabilizes, price ranges compress, and false moves increase. Many traders continue trading here out of habit or boredom, not because their edge is present. Trading literature often highlights that a large percentage of overtrading occurs during these quieter hours when activity feels productive, but expectancy quietly deteriorates. Recognizing when the market is transitioning from opportunity to noise is one of the most important scheduling skills a trader can develop. Later in the session, behavior shifts again. Institutions adjust positions, profits are taken, and risk is reduced. These periods can offer clean moves, but they often lack follow-through. Optimizing your schedule means knowing whether your strategy thrives on initiation, continuation, or resolution, and choosing trading windows accordingly. A breakout strategy may perform best during session opens. A mean reversion strategy may thrive during midday compression. A swing trader may find the best decisions happen after markets close when noise fades and structure becomes clearer. Equally important is aligning trading time with yourself, not just the market. Cognitive performance fluctuates throughout the day. Focus, patience, and emotional regulation are not constant resources. Trading at times when you are tired, distracted, or emotionally compromised dramatically increases the likelihood of impulsive decisions. Many traders mistakenly believe discipline should compensate for fatigue. In reality, discipline erodes when energy is low. Optimizing your schedule means trading during your highest quality mental hours, even if those hours do not align with the most popular market times. Another overlooked factor is decision density. Some trading windows compress many decisions into a short period. Others allow more time between setups. If your strategy requires rapid decision-making, you must schedule trading during periods when your reaction speed and stress tolerance are high. If your strategy rewards patience and planning, slower windows may actually improve performance. Trading literature often emphasizes that mismatch between strategy tempo and personal tempo is a hidden cause of inconsistency. Optimizing your schedule also means defining when not to trade. Economic releases, low liquidity periods, and times of emotional imbalance should be explicitly excluded. A professional schedule is defined as much by its exclusions as by its inclusions. When no trade windows are respected, trading becomes intentional rather than reactive. This alone reduces overtrading, emotional fatigue, and burnout. Over time, traders who optimize their schedules notice a subtle but powerful shift. Trading feels calmer. Fewer trades are taken, but quality improves. Review becomes clearer because mistakes cluster less around fatigue and time-based noise. This is not because the market changed, but because participation became selective. Trading literature consistently shows that traders who respect time as a variable experience smoother equity curves, not because they predict better, but because they avoid trading when their edge is statistically weakest. Ultimately, the best times to trade are not universal. They are personal, strategy-dependent, and dynamic. What works during one phase of life or market regime may not work in another. Optimizing your schedule is therefore not a one-time decision, but an ongoing calibration between market rhythm and personal capacity. And it is precisely here, when trading time is chosen deliberately rather than inherited from habit or fear of missing out, that consistency begins to feel less forced and more natural, as if the market and the trader are finally moving at compatible speeds, even though this understanding itself has not yet fully reached its end. Because once consistency begins to form, the trader starts to experience time not as pressure, but as an ally. This is where optimizing your schedule moves beyond theory and becomes experiential. You notice that certain hours invite clarity, while others invite compromise, that some sessions feel clean and decisive, while others feel muddy regardless of how hard you try. Instead of fighting these patterns, mature traders design around them. They stop asking how to trade more and start asking when their decisions are most likely to be correct. At this stage, many traders discover that fewer trading windows create better results. By compressing participation into well-defined periods, attention sharpens. Preparation becomes more deliberate. The mind enters a familiar rhythm, recognizing when it is time to engage and when it is time to stand aside. Trading literature often compares this to professional athletes who perform best within structured intervals rather than constant effort. The market may be open all day, but the trader does not need to be. Presence matters more than availability. Another important realization is that optimal trading times change with market regimes. High volatility environments may favor shorter, more focused windows, while calmer markets may reward patience across longer horizons. Traders who remain rigid about schedules eventually feel friction. Those who review performance by time of day and session type adapt smoothly. This adaptability does not mean chasing activity. It means recognizing when the market's rhythm has shifted and adjusting participation accordingly. Optimizing your schedule becomes a form of risk management. As scheduling discipline deepens, emotional stability improves almost automatically. Trading during your best hours reduces impulsive entries. Stopping at predefined times prevents decision fatigue. Knowing that you are not supposed to trade right now removes internal negotiation. This reduction in mental friction is one of the most underestimated benefits of schedule optimization. Many emotional mistakes disappear, not because discipline improved, but because the environment stopped inviting them. There is also a long-term benefit that only becomes visible with time. When trading is confined to specific windows, life outside trading regains balance. Rest becomes restorative rather than guilty. Review becomes clearer because sessions are distinct. Burnout loses momentum because trading no longer bleeds into every hour of the day. Trading literature consistently shows that longevity is strongly correlated with the ability to separate engagement from disengagement. A well-optimized schedule creates that separation naturally. Eventually, the trader's relationship with opportunity changes. Missing a move no longer feels painful because participation was intentional. You know why you were not trading, and that knowledge protects confidence. This clarity replaces fear of missing out with trust in process. You stop feeling late. You stop feeling rushed. You arrive when you are meant to, and you leave without regret. In the end, The best times to trade are not discovered by copying others' routines, but by observing your own results honestly. They are revealed through review, through noticing where discipline holds and where it slips, where clarity thrives and where noise dominates. Optimizing your schedule is an act of self-respect. It acknowledges that time, like capital, must be allocated wisely. When trading time is chosen deliberately, consistency no longer feels forced. It feels supported. Decisions improve, not because the market is easier, but because you are meeting it under conditions where your edge and your energy can align. And it is from this alignment, repeated day after day, that trading begins to feel sustainable, professional, and quietly effective, allowing skill to express itself without being undermined by fatigue, urgency, or habit. If this perspective on optimizing your trading schedule resonated with you, consider subscribing to continue exploring the foundations of sustainable trading performance, and leave a comment sharing which time of day you now realize produces your clearest decisions and which window you may need to step away from.